Okay. So the topic of today's discussion is preparing pro forma financial statements. Now the question is, what do we mean by pro forma financial statements? Actually, pro forma financial statements are the future financial statements. But is it possible to know what will happen in future? Is it possible? No. So what we try to do, we try to make a rough estimation, the best possible estimation of the future financial statements. So what are the financial statements? We have several, but the most important financial statements are income statement and balance sheet. So we will focus on these two. We will focus on these two financial statements, how to prepare the pro forma income statement and pro forma balance sheet. You understand? Okay. Is it clear to you? So another name of pro forma financial statement is projected financial statements. So you know about projection, right? We are trying to project the future. We have the balance sheet, we have the income statement of the last year, but we want to estimate what is the possible balance sheet in the upcoming year, or what is the possible income statement in the upcoming year. Okay. So pro forma financial statement or projected financial statement, no, all these are the same thing. Okay. So let us start with pro forma income statement. Okay. You have to know how to prepare the pro forma income statement. Do you know why? Why do we need to forecast? Now, sometimes we also call forecasted income statement or forecasted balance sheet. I think you are familiar with the word forecast, right? You know about weather forecasting. So what will be the possible weather condition tomorrow? Do you understand? So similarly, forecasted income statement means what is the most possible income statement of the upcoming accounting period. Same, what is the possible balance sheet of the upcoming accounting period. Okay. Now, before we prepare a forecasted income statement, we have to review the structure of the income statement. You know, on top of the income statement, we have the sales revenue, isn't it? What is the topmost item of income statement? Sales revenue. Okay. And what is the next item of income statement? Cost of goods sold. Possibly after that, possibly selling and administrative expenses. And most probably after that, after deducting all these things, you get operating income or earning before interest and taxes, right? Then what do you get? After that, what do you do in the income statement? You deduct the, okay, there are some other expenses. You can have several other items, but the most important items are, now after getting the operating income or earning before interest and taxes, you have to deduct interest expense or financing expenses. And after that, you get earning before tax or before tax profit. And from that earning before tax or before tax profit, you deduct tax. Then you get net income or net profit. This is the basic structure of income statement. Of course, we have several variations, but let us think about the basic structure. So, if you think about the cost of goods sold, do you think that the cost of goods sold will always remain the same no matter no matter what is the amount of sales revenue? If a company has higher sales, then what will happen? The company will also have higher production or purchase. So if the production or purchase is higher, then the cost of goods sold will be higher. Again, if the sales decreases, let's say sales will become half, then the cost of goods sold will also go down. Probably it can be half if all the costs are variable. It depends. Okay, so you can understand that cost of goods sold is linked to sales revenue, right? So and then minus selling and administrative expenses. That can also be related to some extent to sales revenue. Maybe not in full extent, but to some extent. Okay, but it is, of course, it can have some link with the sales revenue. So after deducting that, you get earning before interest and taxes, and from here you deduct the interest expense. This one is not related to sales revenue. Okay, interest expense or financing expense is related to your borrowing. Am I right or wrong? It is related to your borrowing. So borrowing or debt is reported in balance sheet. So it is related to the balance sheet. Am I right or wrong? So think about the balance sheet. Asset, liabilities plus equity. So we have somewhere long-term debt. So it is related to this long-term debt, right? So for now, for simplicity, let us assume that our long-term debt will remain the same. Yeah. Let us assume that our long-term debt will be the same. It will not change. So if it does not change, then interest expense will also not change. Are you getting me? Okay. So if you deduct the interest expense from here, then you get earning before tax minus tax. Tax is also related to this one because if the EBT is higher, tax will be higher. Do you understand or not? If the EBT is higher, tax will be higher. If the EBT is lower, tax will be lower. So after deducting that, you get the net income or earning after tax. So where is the starting point of income statement? Sales revenue. Actually, you have to forecast the sales revenue first. That is the starting point of preparing the forecasted income statement. If you do not forecast sales, you cannot estimate what will be the cost of goods sold, this expense. Then you will also not get EBT, and you will not also get the tax, and you will not get this one. And if you do not get net income, then you will not get retained earnings. Do you know what is retained earnings? What is retained earnings? The portion of the net profit that is not distributed to the shareholders or owners. This is called retained earnings. So if you do not know the amount of profit, how can you find how much is not distributed? Do you understand me? So net income minus dividend is retained earnings, and that retained earnings goes to retained earnings. Okay, goes to where? In the equity portion. Okay, this is the common stock, then retained earnings, total equity. Okay, so long-term debt plus total equity equals total. You also have current liability. You will get total liability plus equity. Do you understand? So if you do not prepare the forecasted income statement, you cannot get the balance sheet completed. This is why we have started with which one? Balance sheet, all right? We have started with which one? Income statement or balance sheet? Income statement. Why? There is a reason. The reason is, if you want to complete the balance sheet, you must know the amount of retained earnings. Then otherwise, how can you know what will be the increase or decrease of retained earnings in the balance sheet? Okay. So this is why we have started with the income statement. So if you can forecast, if you can complete the income statement, then what will happen? You will transfer net income minus dividend. So how do you know the dividend? You have to know it from the management. Now, what is the plan of the management? Now, how much dividend will be paid? If you do not have any connection with the management, if you do not have any access with the management who decides about dividend, then what you can do, you can look at the past dividend behavior of the company. Let's say you are an external party, okay, you do not have any connection with the management of the company, you cannot ask them, they will not answer you. So how can you know the dividend? What you can do, you can look at the past record of the company. Now, normally what is their dividend payout ratio, what percentage of income do they pay as dividend in the past? So you can actually reasonably assume what is the amount of dividend. So if you get the dividend, you deduct the dividend from net income, then you will get retained earnings that will later go to the balance sheet. Do you understand? If anybody do not understand, please ask me. Any question? Any question? Sure. Okay. Okay, now that we have got the, actually I have not told you in detail how can we get cost of goods sold from sales revenue. We will talk about that later. Now we are discussing only the overall structure, overall steps. So from after doing the income statement, then if we go for the balance sheet, in the balance sheet we have current asset, we have fixed asset, then we get total asset, and this one must be equal to this one, total liabilities and equity. Am I right? Okay, now think about current asset and current liabilities. These two items are very much related to sales revenue. Current asset and current liabilities are related to sales revenue. Why? Most part of the current asset is accounts receivable and cash and inventory. So if your sales is double, your cash balance will be higher, your accounts receivable will be roughly double, your inventory will be roughly double. If your sales is half, then your inventory will go down because you will produce less. Do you understand? Your accounts receivable will also be very low, probably half of what it was in the past. Get it? So current asset is almost directly related to sales revenue. Again, current liabilities. What are the components of current liabilities? Mostly accounts payable. So what is accounts payable? Payable to the supplier. Yeah, purchase is related to sales. If your sales, let's say your sales becomes double, then what will happen? You will produce double or you will purchase double. If you produce double, you will purchase in raw materials double. So your accounts payable will become almost double. Do you understand? Notes payable, part of notes payable can be current, part of notes payable can be non-current. So we normally exclude notes payable from this portion because notes payable depends on your agreement with the fund provider. For example, bank. If you borrow more, your notes payable will be higher. So normally we only link current liabilities, only link accounts payable with sales. Do you understand? And also probably accruals. Okay, so current asset is linked to sales revenue, current liabilities is linked to sales revenue. Fixed asset, what about this one? Fixed asset is fixed. Am I right or wrong? But remember, fixed asset has a certain capacity. For example, if your company has one factory, one production plant, let's say it can produce 10,000 units. So if your sales, previously your sales was 2,000 and now it becomes 4,000, you do not have to increase your fixed asset. Same factory can produce 4,000. If your sales become 5 times, then from 2,000 it will become 2 times 5, 10,000. Am I right or wrong? So your factory will work in full capacity, will produce in full capacity. Still, you don't have to increase your fixed asset. But if your sales become 8 times, then what will happen? You need to produce 16,000 units. So one factory cannot support that. So in that case, you have to purchase fixed assets as well. So you have to know what is the capacity of your fixed asset. If your sales increases beyond the capacity, then you may need to increase the fixed asset. Do you understand that or not? Okay. So until then, your fixed asset will remain fixed. Okay. You can go for a prayer break for 10 minutes. Will it be okay? I'm here. I'm just waiting for you. So the bottom line is we have to start our forecasting process from which item? Sales revenue. Okay, very good. So, well, now if you want to start with the sales revenue, that means future sales revenue. What will be the sales revenue in the next year? Now, how can you know what will be the sales revenue in the next year? Actually, you have to forecast. You have to forecast the sales. Yeah, that is forecasting. Actually, not assumption. You can estimate. You can estimate based on historical sales data, right? So, where do you get historical sales data? In the past income statements. Am I right? So, you have to look at the past income statement and find the sales of the past income statement and then try to forecast. So, if you look at the income statement of Fair Traders, a company. If you look at this company's income statement, you see that total sales is 100,000. That is actual. It is the income statement of the current year. So what you need to do, you need to forecast the sales of the upcoming year. Forecasting can be done using many sophisticated techniques or tools, particularly statistical tools. Marketing department may also be involved with this. Okay, so whatever, let's say we have found that the sales will increase by 35%. So if the sales increase by 35% in the next year, then what will be the forecasted sales? 100,000 times 100,000 plus 100,000 times 35%. So 100,000 is the sales of the current year plus 35% of 100,000 sales of the last year. So you get $135,000. This is the forecasted sales. Okay, this is the forecasted sales. Okay. So to make you free from any confusion, let me do it fresh with a new example. Is that okay? Let us think about one company where sales revenue is $10,000. Okay, this is the current year. Okay, this is the actual statement. So sales revenue is 10,000. Now cost of goods sold, variable cost of goods sold. The variable cost of goods sold, let's say it is 2,000, and fixed cost of goods sold is 1,000. Okay, is that okay? So gross profit how much? 7,000. So now let us focus this portion for the next year. Forecasted sales next year. Forecasted sales. Let's say the sales will increase by 20%. So if the sales increases by 20%, what will happen? The new sales will be 12,000, right? 12,000, right or wrong? Now, because the fixed portion will remain fixed, so we will not change the amount. Okay, so the fixed cost of goods sold will be 1,000. And now estimate, the variable cost of goods sold is what percentage of sales. So we have to do separate calculation here. So variable cost of goods sold as percentage of sales is equals to, in the actual year, in the current year, it will be $2,000 divided by $10,000. Right or wrong? Right or wrong? Do you understand that? Variable cost of goods sold as percentage of sales. So what is the sales? 10,000. And what is the amount of variable cost of goods sold? 2,000. So 2,000 is what percentage of 10,000? This is what we are doing. So that is equal to 20%. Okay. So in the next year, the variable cost of goods sold will also be 20% of the next year's sales. Am I right or wrong? So can we calculate now? Okay. So let us calculate for the new year. Variable cost of goods sold is equals to that 20%, because in the last year it was 20% of sales. So in the upcoming year it will also be 20% times the new sales. What is the new sales? 12,000. So it is equal to how much? 2,400. So it will be 2,400. Variable cost of goods sold. Okay, now if you deduct that, what is the gross profit? $8,600. This is what we have to do for forecasting the cost of goods sold. Forget about whatever we discussed before. Is it clear now? Okay, so this is how you can estimate the cost of goods sold, right? So after the cost of goods sold, then what else? Other operating expenses, right? Operating expenses. So normally for operating expenses, you can assume that the operating expense remains variable, because the more you sell, the more you operate, the more will be your operating expenses. Do you understand? That can be the preliminary assumption. But you can also divide the operating expense into two types: fixed operating expense and variable operating expense. Fixed operating expense and variable operating expense. So apart from this example, let us think about continuing this example. Okay, that is better. So let's say in the current year, the operating expenses, the variable operating expenses, OE for operating expense. Is that okay? I'm erasing this portion. The variable operating expenses is 500, and fixed operating expenses is 1,200. Okay, so if you deduct these two, then you will get operating profit or EBIT, right? Or EBIT, right? Operating profit or EBIT. So what is the EBIT then? 7,000 minus 1,700. How much? 5,300. This is for the current year. This is the actual income statement of the last year. So from here, you have to get the forecasted one. So you understand the fixed operating expense will remain fixed, and only the variable operating expense should vary with sales. So we need to calculate the same thing. For the last year, we have to calculate variable. Can you see? Okay, let me write first, then you will see. Variable operating expense as percentage of sales is equals to sales is the denominator. What is the sales? 10,000, and variable operating expense is 500. So what is the percentage? 5%. Okay. So it is 5%. Right. So now, if we want to calculate the variable operating expense of the upcoming year, then we will maintain the same ratio, right or wrong? Okay. So variable operating expense is equals to 5% times next year sales, 12,000. So $600. Now we have got it, right? So let us write down variable operating expense is 600 and fixed operating expense is same 1,200. So if we deduct this one, then we get operating profit or EBIT. How much? $6,800. So previously it was 5,300, but forecasted operating profit is 6,800. Got it? এটা এটা তো গত বছরের ইনকাম স্টেটমেন্ট। হ্যাঁ, এটা তো গত বছরের যে অ্যানুয়াল রিপোর্ট থেকে পেয়েছি আমরা। Okay, clear? Now, what about the interest expense? কোনটা? Okay, done or not? Okay, now from the EBIT, earning before interest and tax, what do we deduct? We deduct the interest expense, right? So interest expense for now, we will consider it fixed because it doesn't relate to the sales. It does not relate to sales. So let's say in the last year, the income statement interest expense was 600. So in the upcoming year, the interest expense will also remain 600. But at this point, I want to mention that when we prepare the pro forma balance sheet, we will consider long-term debt as fixed initially, but later on you will find, because I have told you current asset will change, right? Listen to me very carefully. Current asset will change. Now, when we prepare the forecasted balance sheet, current asset will change with sales, right or wrong? Current liabilities will change with sales. Fixed asset may or may not change, right? Then what else do we have? Equity will change because there will be some amount of retained earnings, right? So there will be so many changes in the balance sheet. So ultimately, there is a possibility that the balance sheet may not balance. That means total asset may be less than total liabilities and owner's equity, or total asset may be more than total liabilities and owner's equity. That means there will be an imbalance. Do you understand that? So how can we balance that one? Actually, what we will do, we will change the long-term debt or notes payable for balancing the balance sheet. Let's say total asset became 100 more than liabilities and equity. So what we will do, we will increase the long-term debt by 100. So in that case, it will balance. Am I right? But the problem is, if you increase the long-term debt, then interest expense will increase. If interest expense increase, then net income will decrease. If net income decreases, then return earnings will decrease, and again the balance sheet will imbalance. So that is a circular issue. Do you understand? So in that case, what we will do, we will try to use different figures again and again, trial and error. And normally we will not do it manually. We will ask the computer to try different values of long-term debt so that ultimately we get a balanced situation. Do you understand that or not? For us, it is very difficult to try 1,000 values, 1,000 trial, to run 1,000 trial. But it is very easy for the computer to run even 1 million trial within a very few seconds. Got it? Are you understanding or not? The actual process. So if I ask you, how can you balance the balance sheet in the forecasted financial statements to resolve the circular issue? Can you answer? Yeah. But if you adjust the long-term debt, then what will happen? The interest expense will change. If the interest expense change, again, balance sheet will change. There will be another imbalance. So what will you do? You will have to try different values again and again. You have to try again and again, and one day you will get the balanced balance sheet if you do it manually. Got it? Clear? Okay. So interest expense, for now, let's assume that it will remain fixed. So after deducting the interest expense, then you get earning before tax. So which is how much? $4,700. Okay. Minus tax. Tax is let's say 20% tax. So you have to deduct the 20% tax. How much? 20% of 4,700? 940. So after deducting this, then you get net income. So what is the net income? 3,760. Are you sure? Okay. So do the same for this one. So for the forecasted income statement, what is the amount of earning before tax? 6,200 minus tax. Again, 20% if the government doesn't change the rate. So it will be 1,240. So the net income will be how much? 4960. Now you have to know. So forecasted income statement is done. Okay, you have already learned how to estimate the forecasted income statement. Have you learned? Great. Okay. So now what you need to know? You need to know the dividend. So dividend depends on the management's decision. If you have connection with the management, you can ask the top management what is going to be the probable dividend in the next year. But if you don't have any connection, then what you can do, you can observe the past dividend of the company, and based on that you can assume what will be the dividend. Let's say the dividend payout ratio is 50%. That means 50% of the income is paid, is given out to the shareholders, and 50% is retained. So in that case, you have to separately calculate the retained earnings that will be in the balance sheet. Do you understand? Okay. So this is how you can actually calculate the estimate the forecasted income statement. Okay, preparing the forecasted balance sheet is not as systematic as it is for the income statement. Why? Because there are so many assumptions in case of balance sheet. So you have to rely on the assumption. You have to rely on the assumption and you have to calculate accordingly. So for understanding that, what we will do, we will try to solve one problem from the exercise.